Hey, thanks for that, Jeff. I'm excited to have this opportunity to speak with you all about ESG today. I'm getting my shared screen up here. I think the three main questions I'd like to try to answer today. Give me 1 second to get into the slideshow here. I'd like to try and answer the questions like, why does ESG matter? So you're spending 20, 30, 60 minutes on this topic today. I'd like to try to get into the idea of why this matters to you and to your organization first. The second piece I want to get into are, if your company does or does not, or your organization does or does not engage in some sort of ESG discipline, what are the implications for the operations of your company, for reporting requirements for your company? And third, I'd like to get into a little bit about applicability. So, I think a lot of folks would look at something like ESG. And for those of you who have been around long enough, you might see another Sarbanes-Oxley. You might see a really time-consuming, resource-consuming compliance exercise, and it could be that. I'm trying to make the case today that there's an opportunity to make it a value add for your company, for your investors, for your shareholders across the board, and ultimately should make life easy for anybody who's in the compliance space or anybody who's trying to relate your company and your products to outside stakeholders. So, the first piece has to do with share price. And Jeff touched on this a little bit. There's a lot of data that backs this assertion, but, looking at a few thousand companies over several years, companies that are going into some sort of a socially responsible investing discipline such as ESG, that they're taking the time to share those metrics with their stakeholders, they generally almost always had a positive return on investment. So, we're seeing over the past several years kind of a geometric growth in the dollars that are flocking to ESG-driven organizations and organizations that can show they have some sort of an ESG discipline in place. A couple interesting points there, and we'll get into some graphs in a minute here. But a couple interesting points is, that's been the trend. You've seen a lot of really good activity and returns on publicly traded markets. What's becoming interesting in the past year or so is that there is a lot more demand for privately held companies to engage in some of these same practices. So, previously I think that ESG was something that if you're a privately held company, or maybe if you weren't a Fortune 500 company, you could kind of let it fly under the radar and not worry about it. That appears to be changing, and we're hearing from companies that are involved in the M&A space, family-held investment groups who are all saying, this is something that we're hearing from our big stakeholders on, our big investors on. So just because you're not privately or publicly traded company doesn't necessarily mean that you can avoid ESG anymore. With regard to ESG operations and reporting, we'll talk about this in a little more depth. But currently, there are several choices. If a company hears from their board of directors or from enough shareholders and they say, we want to engage in some sort of an ESG practice, you start Googling on this thing and you'll see that there are dozens of frameworks that could be employed to measure ESG compliance or ESG reporting. And I think that's a challenge and an opportunity at the same time, in my view. And the opportunity is simply that companies will have an opportunity, if they choose to go down this road, to select which metrics they would like to measure. So what I would typically say to a client or somebody who wants to learn more about ESG is, you're probably best off selecting something where you're either already really good and would like to share that with the market or other stakeholders, or maybe you're not so good today, but you think that you can show market improvement over a relatively short period of time and take credit for that. For me, what's interesting is ESG is often about taking credit for the work that your company and your organization is already engaging in. not so much a compliance exercise in creating more work, but simply recognizing some of the things that your organization is already engaging in and taking credit for that. And I think Steve will highlight that point when he presents. Let me scroll down here a little bit. So I've talked about some of why ESG should matter. I think, overall, the biggest driver in this thing is going to be access to capital. I've talked to Jeff about this a few times, and Steve as well. And, I think there's a tendency for folks, especially in companies that are going to have to probably do more work on ESG. If you have a high carbon intensity in your company's operations, or you might have some other exposure to ESG, I think it's easy to see it as a hindrance or a big risk. I think that we'll see that through having some sort of an ESG program, it actually presents an opportunity to outpace some of your competitors, and frankly get ahead of some regulation that may be coming down the road. In any case, operational cost savings. I think that looking at your key metrics, your key performance metrics, is something that a lot of companies are already going to do. But when it comes to an ESG view, and I think in particular with the focus on the environmental aspect of ESG, I think there are some opportunities to look at things like, looking at it from an energy production perspective, looking at things like methane emissions, or your ability to plan for water in say, if you're in the hydraulic fracking area, how do you make sure that you have a robust supply chain? How do you make sure that you're minimizing these things that ultimately could be a risk to your business? If you talk about water for hydraulic fracturing, that's something that a company may not want to disclose typically. But if you're in the shale production business, and it's been a difficult one over the past few years, but as you're probably aware, hydraulic fracturing requires a lot of water, and it almost always takes place in very arid environments. So, with the exception of Pennsylvania, all of the hydraulic fracturing happening in the U.S. is happening in places that are arid or semi-arid. Well, when the water supply runs low, let's say if you have a drought season that's more severe than anticipated, suddenly, one of your key feedstocks for your key commodity is in short supply. And at that point, your choice is either to curtail production or pay more for that feedstock. So, my takeaway in that example is simply, it's something that you need to do to conduct core operations anyway. It's also something that can send signals to the community in which you operate that you're a good environmental steward and that you're a good partner with folks in the community that you work with. There's a few other pieces here that I'm going to kind of gloss over a little bit. I've got some broad examples of what might fall into the ESG category. I think for most folks, and I've had the opportunity to work with Jeff on this, I think that, the E is probably the place if you're in the fuels business, and largely if you're in the manufacturing business, that would make a lot of sense to drill down into. So it's not to say that the social and the governance don't matter, but I do think that there's the biggest opportunity exists, and the most potential scrutiny or regulation might come on the environmental side of things. So, very broadly, we're talking about things like climate risk and plastics, deforestation, things of that nature. These are things that the chances are your insurers, your investors already ask you to document and keep tabs on. ESG is simply asking you to communicate that to the market. We talked a little bit about how the market is actually what is driving ESG for the most part. Things may change in the coming months and years, but for now, it's mostly an access to capital type discussion. And I would say, these numbers are a few months old, but if you're looking at institutional investing in publicly traded companies, nearly 25% of all institutional dollars go through some sort of ESG rigor. So that means if two companies are exactly the same, one has a higher ESG score than another, the company with the higher ESG score will get the investment dollars. The one that has a lower score will not get those dollars. I did also allude to the growth in ESG in ESG funds. And if you're in a company that has a large corporate communications department or sustainability department, I would want to draw the parallel between what we call ESG is perhaps a more robust version of, again, a lot of work you're already doing. So a lot of companies have sustainability reports or corporate social responsibility functions. A lot of those existing efforts will feed directly into and therefore lessen a burden on any ESG requirements that you may have or you may choose to engage in. So the key, I think, is really taking something that's often very qualitative or to date has been qualitative and attaching metrics to it. So Steve will get into that a little bit in a kind of a real world scenario, discussing things like carbon intensity. But in terms of your companies, you may be thinking about things like your scope 1 or 2 emissions, your methane emissions, your plastics usage, things of that nature. And again, I think we may have touched on this just a little bit earlier, but I just wanted the point of this is just to show how much of a demand there is for ESG investing. I think that anecdotally and by the numbers as well, a lot more investing is being driven by millennials, and it will be driven by folks in Generation Z. It's driven more by women than ever before, and a lot of these folks they just care more about and are willing to pay a premium for a higher environmental score. So this graph just illustrates that point. I think one of the big kind of sea changes in ESG occurred earlier this year, back in January, when Larry Fink, he's the head of BlackRock, he issued a letter to CEOs and basically laid out the case that climate change is a big driver in business in general, and that companies needed to implement some sort of ESG rigor. And in his letter, he called out SASB as the framework that he wanted to develop. And I think SASB does a pretty good job of laying out the different metrics across various industry verticals. There were varying opinions, so I took one clip from the New York Times. On the left and on the right, you see the opinion piece from the Wall Street Journal. So people have different opinions of it, and whether you think that Larry Fink is preaching, or you think he's prescient, or maybe you think he's both. But at the end of the day, people like Larry Fink move markets. So I like to make this point. I think a lot of people look at ESG as kind of a political issue or a moral issue or something along those lines. And it might be. My advice on that is to say simply, it doesn't really matter. The markets are speaking, the markets are moving. We may see the voters moving us in this direction as well. So, regardless of your personal opinion on climate change and other things of this nature, I think it's wise to kind of put your finger in the wind and look at which way it's blowing. And it appears to be blowing squarely in the direction of making some of these investments. A question that's come up as well is, well, ESG is kind of a luxury item. In light of COVID, in light of all the losses we've seen in wealth across the country, job loss, et cetera, shouldn't we discount ESG? And the answer is probably not. Jeff shared some of this a little bit earlier. This is actually a Jeff slide, so thank you, Jeff. But ESG outperformed the S&P. It lost less since March, right? But it still performed better than the S&P when things really started to go south. And then when we've had a bit of a recovery, the ESG funds have outperformed the S&P as well. So it's just something to keep in mind. This is something that's happening. Jeff, how are we doing on time? It's funny talking to my computer with people listening, but I'm not seeing any faces or getting any feedback. So I feel like we're doing okay, but I feel like I'm happy to take some questions too.
I think we're good, Ryan. I know I've already got several questions, but I'm going to try to make sure that the audience has plenty of time to ask too. So,
And Ryan, this is Donovan. Did you see the question there mentioned in the quick Q&A box?
Let me see. I
If
cannot
not,
see it. Let me see if
no
I can.
worries, no worries, no worries. Mentions that, have you done any analysis to prove that the differences between companies with and without an ESG program are statistically different? The bar graphs help, but they don't show the differences that are really real.
Yeah, that's so I haven't done research on it. There have been a number of studies conducted, empirical studies with over 2,000 companies that get into their performance. So yeah, you're right. The bar graphs really just show kind of the inflow of dollars, and the performance that I assume you're referring to is the performance vis-a-vis the stock market. So there have been studies that look into a couple thousand companies, and they've shown better performance if there is some sort of ESG program in place. With regard to actual performance metrics, if that's the question, I haven't done research on that either. That a lot of that data. I mean, this is a really important question, right? And it kind of gets into the question of, we start talking about reporting, people start thinking about the Securities Exchange Commission. They start thinking about 10Ks. They start thinking about 10Qs, and ultimately that may be where this whole conversation is headed. If you get into some of those kind of technical definitions, you have to address materiality, and frankly, a lot of companies may have to go through a pretty rigorous process before they decide. One, are these metrics material to their business, and number two, do they choose to share them if it's not required? So we don't have empirical data yet that shows better performance on particular metrics, largely because companies aren't forced to do it, and they aren't forced to choose specific metrics, right? So, if I had to look at my crystal ball to see what's coming, I would imagine that at some point we're going to have an opinion, either from Congress or from regulators who say, here are the metrics that you ought to be reporting on. I would further say that, right now is a really good time for companies and, Fuels Institute members to think about, what are some of the metrics that you want to report on now? So, if this does come up in the policy arena, we can have a really robust answer that says, actually, Congressman so-and-so from California, you want to regulate these 4 metrics. We've actually already begun doing this. We've already begun recording it, and here's why. These are the important metrics that we need to measure. Speaking as a subject matter expert who works in this industry, I think that being in that place is really advantageous, rather than waiting for an egghead from some place that's not where you live to come and tell you how you need to share your information. So I don't know if that was even the question that was being asked, but that's my answer.
I do think with Morningstar's recent purchase of Sustainalytics, it kind of begs that same question, right? What is material here? If there is a lack of standardization, to Ryan's point, and right now there's folks that lean on the Sustainability Accounting Standards Board, SASB, or they're looking at other standards, right? I mean, they're not standards, but they've done a lot of work in this area, and nothing's really been standardized. But that is something that I agree with Ryan. It's coming.
Yeah, and I don't know if you can you still see my screen?
Yeah, you're not in view mode. There you go.
Okay, so this is an example. I haven't seen any legislation recently, so there was something that came from a congressman out of California in late 2019. But just given all the discussion, just given all the policy discussion, in the House as well as on the presidential trail, it wouldn't surprise me if something like this at least came up, right? So again, I'm not advocating for one approach or another, but I am advocating that we all educate ourselves on these topics as much as possible in case it does come up, so we can propose the solution that's most beneficial to our businesses. and this is, this is just a discussion on privately held companies and should ESG be a consideration. That's going to have to be, and frankly, that's for probably companies beyond the Fortune 500. That's probably a discussion as well. I would just say, and I mentioned this earlier, but I have found that investors are increasingly demanding on this point. And it may be just as simple as them saying, hey, do you have ESG? And they might not know, what the three letters stand for, but at some level, if the board or the investor is asking for it, I'd say it would behoove you to have some sort of an answer in that area. So that, Jeff, that's really the high level of what I got. I feel like I've spoken for a long time, and I'm looking at my clock here. We're half past. So I'm gonna stop and answer any questions and maybe turn it over to Steve.
That sounds great, Ryan. Thank you very much. For the sake of time, let's roll over to Steve Przemyski and.
Yeah, I'm gonna give you guys a little change of speed here because I am a engineer through and through. So I'm gonna show you a bunch of nerdy slides. So let me pull up my PowerPoint deck here. Sorry, that shows I'm over 40. My slide deck got to be cool now. All right, let me see when this thing shows up here. Make sure I get the right one. Oops, sorry. So give me a thumbs up, Jeff, when you see it. All right, cool. So I'm going to talk to you a little bit about lowering the carbon intensity. I think Ryan did a great job explaining why ESG matters. I'm going to talk to you a little bit about what you actually can do from the oil perspective, all the way through to downstream, and a little bit why it matters. It's very simple. You guys remember Jerry Maguire, show me the money? That's what it's about. It really comes down to, for this, a lot of people, show me the money. I make all these graphs to go to Saudi Arabia. Steve, show me the graph. They tell me how much money it is, but there's money to be had. All right, let me go. Oops, why am I not scrolling? There we go, sorry. Before I do anything, I gotta make two things. First off, Thursday is my last day at Aramco, so I can say whatever I want, and I can't get, they probably won't hear about it and fire me before then. But I'm gonna move on to Argonne National Lab next week. But before I move on, I do wanna warn you, don't take anything here as fact. These are models, calculations. Don't make financial decisions, definitely. If you were on my team, you would know definitely don't take financial advice from me. So with that being said, don't try to think you're gonna make money off of this. You can try, but you'd be doing better than me. All right, next thing, I gotta thank, this is a work of a lot of people in Aramco, people at Oak Ridge National Lab, people at Argonne National Lab, and Stanford University. And I'm going to talk to you a little bit about why I have Oak Ridge, Argonne, and Stanford. And as Ryan said, I'm going to just go real quickly. I'm talking about increasing value. So you may think you know you're the best. You may do this. You may do the calculations. How are you going to prove it? If Steve from Aramco goes up and says Aramco is the best at whatever, this and that, and I go, trust me, doesn't mean too much. Third-party accreditation. In our case, we're all engineers. We're kind of nerdy. So we go to the super nerds at the national labs and the high-end universities and have them do some calculations and check, make sure we did our arithmetic right and such. Sorry, I don't know why I'm having trouble switching slides here. Okay, there we go. All right, here's what I'm going to go through this pretty quick. I'm going to try and do this in about 10, 12 minutes. I'm going to tell you, for those of you who don't know what Aramco is, I'm going to get 2 slides. I'm going to talk a little bit about what we can do in upstream. For those of you that don't know, I'll explain it. Midstream is more like refineries. Downstream is sort of in the vehicles. And then this one quick final thought. So for those of you that don't know, have been looking at stocks, biggest IPO in history, all this sort of thing until Ant comes out maybe. Saudi Arabia is the Arabian American Oil Company. That's what it stands for. So it's headquartered in Dhahran, which is on here, Google calls it Persian Gulf, and in Saudi Arabia, they call it the Arabian Gulf. This is basically this area. Can you guys see my mouse okay? Thumbs up. Okay, good. This is where all the oil's at, is, this sort of area. No oil over here really. But they sell almost all the refined products here because people come through the Red Sea. All right. Again, if you don't know about Aramco, it is the world's largest integrated oil company. Couple big facts. This number on reserves changes every year. Last year it was bigger, this year it's smaller. Refinery capacity, we're one of the biggest in the world. It's going up every year because we're buying more stuff. Base oil is just for lubricating. If you know, that's like when you pour oil on your car, that's 80, 90% of what you have is base oil. This is the big number. 12 million barrels per day, maximum sustained. They don't do that. They do about 10, 9, whatever. It depends on OPEC cuts. 12 million, to be honest, this is more than the 5 super majors combined. Put in perspective, Exxon and for oil, not oil and gas, but Exxon and Chevron, 2 biggest in the US, are a little over 4. So it's by far the gorilla in the room for oil. All right, enough of Aramco. Let's talk a little bit about what we can actually do. So I've got this one graph. So I say, when I say upstream, we're gonna talk about oil production emissions. Midstream depends if you're in the transportation world. If you're a Tesla guy, you're talking about electricity. I'm not gonna talk about electricity at all. There's tons of people you can talk about that. Solar, wind, whatever, that's for another talk. I will talk to you a little bit about refineries. There are some pipes that connect the fuel. It doesn't just magically go from one to the other, but you know, they're pretty much inconsequential for the big picture. And in the end, you got to burn the stuff, do something with it. And that is where a lot of the emissions come from. Put in perspective for when you burn a gallon of gasoline, it's roughly about 10% of the carbon is generated here, roughly. About 10% here and about 80% here on a car. On a jet, maybe it's a little bit more like 12, and 76. Okay. So I'm going to show this one graph. It's a lot to look at. So I'm going to just point out, this is honestly, this is probably, if I did nothing else at Aramco and I wasn't quitting, I could probably just sit on my butt for a couple more years and still survive on what this work is. Because this is the ultimate of show me the money. So what we're looking at here, this is carbon intensity of oil produced on this, in this case, it's on a regional basis, country by country. We also did this on a country basis, or I'm sorry, a company basis, but we don't show that publicly. Now what happens is red is bad, Canada, high, it's oil sands, you expect to be bad. Blue, good. Saudi Arabia is KSA, Kingdom of Saudi Arabia. This dashed line is the average, and it's about 10. I'm going to talk in grams of CO2 per megajoule. So megajoule is a unit of energy, and so this just standardizes everything. The one thing you want to point out about this is why the company cares. We knew we were probably the best. We did internal studies that we proved ourselves were the best. But then until you get out and you go and publish it in peer-reviewed journals with somebody like a Stanford, Adam Brand, if you don't know, is probably one of the top respected people in the petroleum field. And so this one we published with Adam in Science Magazine. It's a fairly respected journal. And so what happens is, if you look down on the bottom, if you can't read this, the best in the world is Denmark with a whole 200,000 barrels a day. Then there's this big Saudi Arabia, 10 million barrels a day, and it's really low. On the left side, bad actors, Algeria, Venezuela, Cameroon. Now, one thing I want to point out, we didn't just do this to say, look, we're the best. It's also to highlight the practices. What made it Saudi the best? If you look, Iraq and Iran, these are essentially almost similar geologies, they're not the same fields, but they're very similar. Why are they so bad? Things like flaring, gas management, their practices are bad. So another thing you can do if you're Saudi Arabia is highlight our great practices. Here's where we are. You kind of shame your competitors. We're already there. We have great gas management, best among the best in the world. Now you can shame your competitors into either they got to put up some money, or if carbon has a value, they got to take a loss on the price of their crudes. So it's a competitive advantage to have good ESG practices in this case. And now one thing I want to point out, so this is also from that science, this isn't from the supplemental material. Sorry, some of these graphs aren't the prettiest. This is what engineers do. We make line graphs, we're kind of boring. What we want to do is just say, this is the cumulative oil production. Who's actually making the high carbon? And one thing I want to point out is when you get to the top 10%, these people are especially troublesome. So again, I'm down here at the bottom. These are competitors that I know are at risk and have trouble. So maybe I can take advantage of them. But the other thing you can do is just say, from a regulatory point of view, if a regulator wants to get on us for our carbon intensity, what realistically can the industry do or the company? So this one, we just did a couple of very, very simple scenarios to say, what could you do? And basically, if you want to think about it, you can drop the carbon intensity of crude production worldwide about 43% by doing very manageable things that we know how to do. It's just a matter of getting people to spend some money and do the things they know how to do and have an incentive. So again, this is where like Ryan or somebody would be to come in and maybe tell us, this is why it's good for you to do this. It's also good for the environment, by the way, but it's good for your bottom line too. Just real quickly, these are cutting some flaring down to modest numbers. These are not like crazy. The extreme number is more like Norwegian stuff. So right here, it's 0.2 grams per megajoule. And then we're flaring is the 5th percentile. And then, you know, if you combine everything together, it's great for the world. Okay, so let's just not talk about oil anymore. Everyone also just want to point this in here. Natural gas. Everyone thinks natural gas is better than oil. Just like oil, it depends where you get it from. And I forgot to mention, we did that on a field basis, like 9,000 individual fields. So we actually calculate from a field somewhere in the world, which basically means a couple holes in the ground, what the intensity was. Do the same thing for natural gas. Don't worry about the slide too much. All I want you to do is look at big numbers are bad. Small numbers are good. And everyone might think, well, natural gas is natural gas. Well, it turns out you get it from Central Asia, even though it's in a pipeline, horrible. Lots of fugitive emissions. You know, LNG in the US, very productive, very minimal fugitive emissions. It's actually quite low. Australia, not so good. Anyway, whole point is, you got to look at everything. Where are you getting your products from? If I'm a regulator, I want to know. I don't want to say natural gas is this, because this natural gas from the US is not the same as that natural gas from Central Asia. So as a regulator, I have to know. So one thing the companies can do, like Aramco, is if it's our advantage, you start making this information public. Again, put yourself in a good light, get ahead of the curve, put the screws to your competitors a little bit, make them improve, or get out of the way. One thing I also want to point out, just in general, for those of you environmentalists, natural gas is going towards higher carbon intensity anyway. It's not going to the easy stuff. So let's talk a little bit about midstream. So now I think, hopefully I told you that on upstream, you can do something about it. You can track it. You can make these sort of evaluations of it. So refineries. This is kind of a hard to look at graph. So I don't want you to look at every individual thing. What we're looking at is cumulative gasoline production. And as it's going up, and this is the carbon intensity. So we call this one the gate-to-gate refinery emissions. So lower is better. Here's the average. All I want you to point out, I'll point out on this is, on refineries, it depends a lot. I mean, the answer for a lot of things is it depends. In general, these sour crudes and the heaviest crudes tend to be more carbon intense, but that is not entirely universally true. And the reason for that is because refineries are set up to make a specific set of products from a specific set of crudes. Some refineries are built, like in the Gulf Coast, to take sort of heavier, sour crudes. So shale actually doesn't do them any good. It's too light. And then this is where we did is, again, if you're a regulator and you want to know where things are coming from, this is just to say, where are the CO2 emissions generated? This SMR, steam methane reforming, this is made to make hydrogen. It's one of the most important things in refineries, hydrogen in the coke burn. Now, once I sort of, don't worry about the details, you can look at the charts on the recording later. Once I sort of know where things are going, I can also make a calculation. Where can I make my improvement? So this one is a study. This one's already public. This one is, actually I should update this. This was Nature Communications, updated for the final one. We basically said for gasoline and diesel, we took all the refineries in China, and there'll be one for the rest of the world eventually, don't worry. And said, if we just said there's no GHG emissions from electricity and hydrogen. Now there's multiple ways you can make hydrogen renewably and electricity. Solar, you can use electrolysis with renewable energy. These are all things that a refinery, some of them are starting to do because it's in their interest. So now I can get about 19% on gas. The reason the diesel is a bigger reduction is because it uses a lot of hydrogen, which is, if you use steam methane reforming, or in China, they use coke burn, which is why this is a Chinese case study. So they do coke burn, especially nasty stuff. So if I can get that renewably, I can get 39% out. Now remember I said it's about 10% and 10%, but I just took about 40% out on one end by doing nothing that the consumer sees. I just took maybe 40% out on the midstream, again, by doing nothing the consumer sees. That's every drop of gasoline or diesel that every car in the world potentially could use, and you just saved about 8% of the entire wells to wheels of the entire fleet. So I think it's a huge number. We're talking gigatons. Let's talk a little bit about downstream. This is actually where my specialty is. I'm actually a vehicles guy. I'm not a petroleum engineer. So I'm just going to talk to you a little bit about this. So I've got a couple charts here. Don't worry, I'm going to explain them. GREET is a model from Argonne National Lab. And what it is, it's basically the gold standard in North America and China for the CO2 emissions or greenhouse gas emissions from a lot of things, but this one is showing transportation. Lower is better. What we have here is ICE is internal combustion engine vehicles, conventional. These are like, this is your typical like a Chevy something or other. Mild hybrids. These GCI, opposed with, these are sort of Aramco technologies, fancier engines. And this one is if we use Saudi crude, it also drops it down. The blue is the vehicle cycle. Lower is better. So electric vehicles, they do take, and hydrogen fuel cell vehicles, they do take a little bit more energy to produce. Green is the fuel cycle. Well, in these cases, it's electricity. And then the kind of amber or orangish color is the tailpipe emissions. So this is combustion gases. There's none on EVs. One thing I want to point out, 2016, we thought we were looking pretty good with the ICE vehicles because we were competitive or better than some of the BEV 210's 210-mile range. That's basically Tesla S. And the 70 was originally, it's like a 70-mile range. That's like a Nissan Leaf back in the day. And that's China and US, because China has a worse electric grid. They also don't have as efficient a manufacturing, so they're higher on both. One thing I want to point out, though, is when we get over here onto the latest data, okay, cars have gotten better over the years. But EVs, because of two things, their manufacturing has gotten much more efficient, primarily batteries. And the other thing is the grid is just tremendously changing. And so EVs have an advantage. They can keep taking advantage of an ever-improving grid. So they've got that. But what we can do on the ICEs, I can't change the tailpipe. Your car gets 17 miles per gallon because you got a big old truck. That's what it gets. But we can give you something on the front end, is this green part to lower down a little bit. So there's still room. So it's not like abandon hope. For some of these people, if they're incentivized, they actually can make the investments, and it will make a difference because of the sheer numbers. So a regulator, environmentalist can get a win out of this, and the company can get a win with some money. I just want to show this one. This is a graph we did. The Chinese part was published just this couple weeks ago, actually, Nature Communications. We did this one with both Oak Ridge and Argonne National Lab. And essentially what we're looking at
here is two stories.
And the reason I point this out is we didn't talk about policymakers, but when we talk about ESG, a lot of it's going to be that it's going to be dictated by policy, correct? If there's a policy that puts a carbon price on or something, or policy that incentivizes it, the policymaker usually has a good intention, usually. Sometimes there's some strange things happen. Let's say in this case, they want to lower CO2. So what these are is two scenarios where lower is better. These are basically the annual greenhouse gas emissions. So the US is getting more efficient over time, so they're dropping. Now what happens is, in one case, I incentivize internal combustion engines, and in one case, I increase the battery electric vehicles. The way the current regulation sits, it says a BEV is a zero tailpipe. So essentially, the reason when you say, wow, I'm selling more batteries and I'm putting more CO2 in the air is, well, what's happened is, I'm going to pick on General Motors because I didn't work for them. Worked for one of their competitors. General Motors, every battery electric vehicle they sell, they maybe also get to sell a Chevy Suburban, and it still gets maybe 17, 18 miles per gallon, instead of a Chevy Suburban that gets 20 or 22. So, and this is because the electric grid does put out some emissions. Eventually, I gotta be honest, 2050, the lines start to converge, they look a little different. And the China one, I'm sorry, I gotta move your guys' heads over here out of the way. You'll see here, it's already starting, and eventually they'll crisscross. And then it doesn't matter. The battery electric vehicle is just so much more efficient in the long run that the improved internal combustion engine just can't catch up. So this is China on the right, and this is US on the left. All I want to put out in this one is just to just sort of say, policymakers sometimes get it wrong. If I have good ESG practices, maybe I actually have a chance to say, go to policymakers. They will actually listen to me for once. They might take some of this in consideration and say, Steve, okay, you work for Aramco. Can you convince Aramco to save us a gigaton by doing something else? I'll say yes, because we're on top of it. We already got this in place. We're moving. So that's one thing. I don't want to sit here and beat up on EPA or Chinese policymakers. It's just the company could be in a better position if they're prepared themselves. And this is just because I was telling Jeff, I love talking about cars. I got to talk a little bit about, cars. Okay, in the future, post-tailpipe, mobile carbon capture. Sounds crazy. Yeah, you can't even do it on a power plant. But the fact is, Aramco has built a couple of prototypes going back. This Class 8 truck is currently running around. It drives, everything. It's real. This is the sketch, but it's actually testing down in Ohio, last I knew. And everything fits. So you can capture about 50%. So all I want to do is say this is maybe some point in the future, something you could do. I just want to sum it up for a light duty vehicle. Let's just say you start at 30. I gave you some minimal flaring and fugitive emissions on crude. On the refinery, I cut some renewable electricity and hydrogen. These are completely possible. Less than 10 years from now, you could have them everywhere. And you know what else is cool? These two companies, well, maybe not refiners. They're a little bit hurting for cash unless they're owned by Aramco. They have a lot of money. They got a lot of capital. Automakers getting a 45, they're dying. I mean, they don't want to spend a penny on anything. Mobile carbon capture, okay, even if you don't get that until some point in the future, you still can drop a lot of your carbon emissions. And this is not necessarily a company's ESG. This is just for the good of the environment. But along the way, if I'm a good company, I have a good, we mentioned, do people do it because of their morals or their soul? Well, it doesn't matter to me if they do it, as long as the end result is good. As long as these people do this, and then you can say the automakers do this, overall, the whole country's better off, the whole planet. And then we also got to talk a little bit about the future fuel, just because I know we mentioned, I think when the original blog or the blurb went out about this meeting, it also mentioned marine and aviation. I have some aviation slides I saved for the backup. I was really hoping to bust out these cool things. But just real quickly, marine. Because transportation includes marine. Fuels Institute has looked at marine fuels because you heard about them dropping the sulfur, and everyone said the sky's going to fall, refineries are going to close, all this stuff. Well, none of that really happened. But the future, some people are saying, is hydrogen or ammonia. If you don't know, ammonia is 3 parts hydrogen, 1 part nitrogen, but it's only about 17% by weight hydrogen. So you don't get a lot of hydrogen for the mass. Problem with this thing is you got to go about -250 degrees Fahrenheit. It's cold. Be honest, neither one of these I don't think have a real good place in transportation. Fuel cell vehicles, whatever, they have some place, but not liquefied hydrogen is what I mean, not cryogenic. And ammonia is kind of dangerous. It kills you if you get a leak. But there may be a future there. And I just want to point out, just a couple of days ago, so I had to throw this in, Aramco shipped 40 tons. We call it blue ammonia. There's also blue hydrogen. Blue means it's from a fossil source, and we try to make it clean with carbon capture. So this is a real carbon capture plant, and this is a real boat, and it went to Japan, and they're going to ship 40 tons for power gen. So just in the future, fuels don't have to be liquid hydrocarbons. They don't have to be gasoline and diesel. So final thought, all I want to do is leave everyone with this thought. Regardless of what you think about ESG, regardless of your motivation, there are environmental goals a lot of people have, and you really need to look at a holistic approach. I think when I think of ESG, it's more of a mechanism, using a little bit of a carrot and a little bit of a stick. Maybe the carrot is some cash, maybe the stick is some regulations, but it's something that I think more companies need to consider. Just as an engineer, there's a big opportunity to reduce emissions through a bunch of process improvements. These are things we know how to do. These are engineering things, engineering solutions. These don't require breakthroughs. They require some money and some incentive. You gotta want to do them, and then you will do them. The other thing is this is one where I think you really got to get into now. This is Ryan's world. When I look at carbon across the entire value chain, how do I monetize these? Who actually is going to take the advantage of this? Who's going to make the money? And as say a policymaker or somebody, how do I make that move, or as an investor, how do I make these people move the way I want? I don't want to have some perverse incentive where one person does something that looks good for them, maybe reduces their scope 1 emissions, but increases scope 2 or 3 for someone else. That's not the intent. So this is where the policymakers and other people like Ryan can come in. So that's it for my talk, and I am more than happy to take some questions from you.
That was fantastic, Steve. We have one question. Somebody is asking if we're going to have the slides available, and I do believe Donovan's recording this session. So
Yeah, so I'll tell you, we're recording a session. If anybody wants the slides, these are all public. Everything I showed is, you know, most times I quoted peer-reviewed journals. All of these slides have been made public. My email is going to change. So I didn't put it on a slide, but I think we can get an email out to the group. Anybody wants them, I'll shoot you a PDF if you want the actual slides.
okay, are you good with that too, Ryan? If we
Yeah, definitely. I think Steve's are a lot cooler than mine, though.
That's the first time I ever heard that. Normally, I'm like, wow, there's a lot of nerdy. You got to be honest, the sales guys have cool slides, like they show a picture and beautiful story, and mine are bar graphs, but more than happy
cars and boats and planes.
I like the message, Steve. I mean, it's pretty easy to see how you can apply these strategies downstream as well, and you know, whether you're at the terminal or blending at the terminal, you know, lower carbon fuels, or you're retail blending, you know, how do you incorporate other fuels into the mix you know, we have the tools already. Like you said, we have the GREET and GREET 2.0 model. Yeah, it's used by LCFS, you know, and by CARB under LCFS. But I mean, those tools are available to us where we can say the carbon intensity of this fuel is X versus Y, and you know, we can track those things throughout the whole value chain. So that's pretty exciting stuff, and I do think we're going to continue talking about this. And what I like about it is in a time where there's not a whole lot of consistency or ability to look into the future, we're getting some strong indicators from investors and from boards of directors, and you know, that this is what people want to see. And if we're looking at 10% or 20% upstream and midstream, okay, what has to happen downstream on the other 80%? And so, as you guys know, the Fuels Institute works very closely with other organizations on that other 80%, on, you know, potential future policies and things of that nature. So this has been fantastic. I do believe we've got another question here. Let me check real quick. Steve, can you see that question? It's from Fine.
Let me refresh here. Okay. Okay, what is the prospect for commercializing the mobile carbon capture in the light duty fleet when the policy investment focus seems to be on EVs? That's a great question. Right now, the prospects are pretty close to zero. I mean, to be honest, nobody's going to spend a bunch of money to put a mobile carbon capture system on unless there's something they're going to get out of it. On the light duty side, it's a little challenging. It's not incredibly expensive. I'd say this again, it's technologically feasible. It's an engineering problem, no breakthroughs. But I think the better place, which is why we at Aramco went with the Class 8 truck, is to move it to the areas where it's harder to decarbonize, and where it's easier to probably absorb a mobile carbon capture system. A Class 8 truck, it fits better. A lot of them are fleets, so they can centrally refuel. They can centrally unload their carbon. That thing I didn't mention too much, it's sized for an entire tank of fuel. So until you refuel the entire tank, you don't have to unload carbon. And the other one we're looking at is potentially marine applications. These systems are kind of big, they're kind of expensive, but there's not a whole lot of other ways to get marine out. And if you want to burn bunker fuel, which a lot of people do, and you got to lower your carbon intensity, this is maybe an option. You know, storage of the CO2 is a little bit of a problem, because the funny thing is, as you're driving down the road, the car gets a little heavier because you're making more CO2 than fuel that you're burning. But again, on a boat or a Class 8 truck, this is not a huge problem. So light duty, don't expect it. But it depends how desperate you get on heavy duty and marine. Not on airplane either. So one thing, Jeff, you mentioned earlier, I just want to point out, on the upstream side, oil company side, I think it's quite easy to see the incentive. I mean, that work we did with Stanford is probably the best money our Aramco has spent in a decade. I mean, we paid poorly. Some postdoc at Stanford paid us in Detroit a little better. And honestly, the company is now sees potentially billions of dollars of long-term revenue due to higher oil prices when a carbon price is implemented on them. And I think if other companies start to see the same thing, they'll start to put the improvements in place, and they'll see it's value added. Refiners, it's also, just needs incentives. Downstream is a tough one. That's why I want to concentrate on downstream. Is how do you get these guys to realize it might be in their best incentive? And it's not just, I'm going to do VEVs. So
yeah, and to approach ESG in a manner of, making sure our company is optimally and efficient, and how are we operating? Taking that close look at your best practices on reducing costs, on improving fuel margins, et cetera. So it goes beyond a stamp and investors, right? It's really a look internally, which most companies are very apt at doing. I mean, they do it all the time. But to look at it through these lenses, how do we reduce waste, whether that's labor hours or actual material goods, and increase our bottom line. And I think that's a very healthy approach when you're just starting to look at ESG, and you're setting up a core group in your organization. Where's the waste? Where's the money leaving, and why? Asking those questions. And I think what we're starting to see too is the question on ESG scoring and planning, is we're starting to see it throughout the whole chain, right? So if you are, for example, putting a bid out for a fuel supply contract, chances are you're going to see some of these types of questions in an RFP. And just as well, you should be asking your suppliers too, what are they doing in this space, and is that going to be reflected in a reduced cost? So
yeah, I think there's two more questions. The last one actually looks pretty interesting to me. You see it there, Jeff?
let's see. We got Tammy's. Okay, let's see. The first one: do companies with ESG programs outperform the S&P because they are better managed, or because they have an ESG program?
I'll take a shot at that one. I think it's a little bit of both, but I think companies will see an initial bump, just for saying, hey, we have a climate change perspective. Hey, we have a sustainability committee. We have begun implementing an ESG program. So initially, you can get a bump just for saying the words ESG and making sure that your subjects and your verbs agree. As you get further down the road, the metrics matter more.
Yeah, and
there are a couple of examples, like proto ESG examples, where like Whole Foods made a big announcement 10 years ago. And they said, hey, we're going to paper bags only. And they got a 10% bump in share price. McDonald's did something around the same time frame. They published all of their nutritional information on their menus. They got a day over day bump of like 1%. For McDonald's, that's a really big bump. It's a big ship to turn. So yeah, initially you get a bump, and then I think the numbers start to matter more and more.
One of the things Ryan and I were talking about a little while back too is, starting to see artificial intelligence being used to assess the company, whether you have an ESG program or not, right? So it's basically searching the internet, and it's got key questions that it's asking about certain companies. And if you're not out there publishing and telling your story, someone's going to write your story for you, is what I really kind of got from that message. And it's not happening too often, but it seems to be, we're starting to see a trend in that direction. But I do believe that at the end of the day, it's simply a better managed company when you're looking at all these intricacies on waste and all the above. So okay, next question. Oh, we got a couple more that came in. Let's see. What type of policy or suite of policies would be best to move the needle carbon tax or focus on R&D support and clean energy funding?
Steve, you want to answer that one?
Oh, I only got 2 days left. Like I said, I can't. It's gonna be hard for them to fire me by next year. And if they fire me, I'm gonna get a severance package. It might be cool, actually. Anyway, so I'll take this one. Okay, so previously, I would say, you know, my previous background was Department of Energy, was supporting R&D. I think it was quite successful, but the reality is, I don't want to say a carbon tax, but an incentive of some sort that has a financial impact. Is nothing moves the needle faster than that, because the companies are always chasing that almighty dollar or trying to avoid bankruptcy. That doesn't necessarily mean a carbon tax, but some sort of incentive. And you know, a lot of times we like to talk about it as a carbon tax, but maybe there's another, like the LCFS. It's not a true carbon tax. But I would say that is the case. I mean, supporting clean energy with funding, yeah, it's great. But to be honest, we need to look at the big scale of like a refinery, tens of billions of dollars of investment, and oil companies and energy companies, they put these things up without really blinking too hard. To add a few $100 million here and there is not the end of the world, to be honest. I'll tell you, Motiva, the largest refinery in the United States, the Motiva Port Arthur refinery is owned by Aramco now. If you give them 5 cents a gallon incentive, they'll spend the money. You'll have renewable solar panels all over the damn place, whatever it takes to help bring that carbon intensity down, if there's a monetary incentive. So I hope that answered the question.
Yeah, the timing is good. I mean, I know at the Fuels Institute, we see the R&D work that DOE is getting behind, and they have for many years, kind of behind the scenes. But my background has always been in the incentives. You know, whether it's an RFS RIN value that's adding something, or an LCFS carbon credit value. I mean, that really does seem to move the needle very quickly. Okay, last question. I know we're out of time, so California's LCFS has been in effect for 10 years, and it has not been successful in reducing the carbon intensity of domestically produced gasoline and diesel by even 10%. What does this imply for the feasibility of the carbon intensity reduction concepts that you have identified? By the way, your slides and underlying analysis are terrific.
I think that one's to me. Thanks. Yeah. Yeah, thanks for the compliment, by the way. Yeah, I think it's a great. The reason I like this question is it points out almost what I said earlier, is there needs to be an incentive. People are going to look for the cheapest way around, loopholes. I think the LCFS was originally, and Jeff and Ryan, you probably know more about this than me, was originally intended to do some carbon differentiation on crudes, mainly to penalize the Canadians at the time. It doesn't really do it that way. It doesn't work. So one thing though now, Adam Brandt, Stanford's in California, he talks to regulators on the upstream side. You now have the data, you have the analysis tools, you can update them. You can actually go by the oil field. You can actually differentiate. Before it was very difficult. Now it's possible. And on the refineries, it's also similarly, we're working with Jewel Bergeson at Calgary. She's very famous in the refinery world for analysis. To do the same thing. And these things like putting, I'll tell you, Aramco at least is investigating. I don't know about others, because they feel this is going to be the future. Something as simple as putting like some animal fats in your cat cracker to bring the carbon intensity down. A few years ago, I always like to joke, if you told the plant manager this, they take you up to the top of the distillation tower and throw you off it. But now we're talking about maybe doing demos on this, because there's actually, again, there's going to be a financial incentive of some sort eventually. California is not the only ones that have the idea of the LCFS, by the way. So if you're a global company like Aramco, you got to get ahead of it, because you know eventually the pain's going to come. So you want to get ahead of it before your competitors can. And again, these people have money. I don't want to tell policymakers how to do their job, but these are people that have money you can make do work. To be honest, on the other problem I always have trouble with is still the downstream transportation guys. It's just, they don't seem to want to move as much or as easily. But the feasibility, everything I showed you is actually just an engineering solution. There is nothing difficult about it, except that you have to get off your seats, move a little bit, spend a little bit of money, and just do it. But it's all possible for everybody.
Yeah, I think if we go down this path of a national LCFS program, I think it's very important that that message be told, so that we're not stuck with a standard carbon intensity for ULSD, a standard carbon intensity for gasoline, and give industry that flexibility. You know, for God's sakes, I mean, it begs for improvement, right? And I think that's very wise.
I think only one thing, you got to be a little bit careful that you don't just make I pick a low carbon crude and a low carbon refinery. So it takes a little bit of finer hand, because you do have to actually still make other products out of a refinery. Some refinery has to, make the harder produce fuels. Not everybody can just do a straight run kerosene and, throw it into a jet. So even so, I think this is where, again, now this is where people like Ryan come in and say, how am I going to design this? How am I going to account for it? And then people like me, the engineers, we'll give you tools to do it. That's not our problem. Our problem is to figure out how to make people do it and how to reward people for doing it.
Yeah. Excellent. Well, I know we're beyond our time. Ryan, it looks like you're chomping at the bit. You got a question here?
No, I just wanted to say, I think that, I don't have the answer to, why LCFS should or should not be extended, or whether it's been effective. But I do think one really positive outcome from an ESG discipline could be that there's more access to operational data, and that's not even so much at the regulator or the government level, but at the entity level. If you're a widely dispersed, geographically dispersed company, and you've got people all over the country in relatively small areas, you might not track your data right now. And this may push you towards actually doing that and identifying some kind of low-hanging fruit in some places where you can actually improve quite a bit without draconian regulations. So I don't know. I'm excited about the opportunities to just have better business insights. I think the business MBA will always say, like, well, I don't know the answer to this question. I need more information to answer it properly. And I think we're kind of driving in that direction. So I'm with Steve, though. This to me makes sense from a business case. So don't do it because I'm telling you to. Don't do it because the markets are telling you to. Do it because it's best for your business.
Very good. That sounds like a great place to end.
Great.
Gentlemen, I appreciate your time. This has been fantastic, very insightful, and I look forward to more discussions in the future. So hope everybody has a great day.
Yeah, Steve, thanks so much. Thanks,
Donovan.
Donovan.
Thanks, guys. Pleasure. You guys have a
Thanks,
great day.
guys.
Bye-bye.